So as we move on to management then, what's been one of your most memorable experiences, both positive experience and negative experience?
Yeah, had some howlers. I think you probably remember the bad ones more than the good ones,
I
sadly.
think that's true, actually.
Yeah,
I know,
that's true.
and it kind of made me think a little bit about what really rankles me in a management meeting. And I think overarching is where a chief exec or a management team is really quite salesy and very high level, a bit patronising.
Hello and welcome to Investing for the Long Term with Judith Mackenzie and Rosemary Banyard. Judith is partner and head of Downing Fund Managers, and Rosemary is an award-winning fund manager who manages the VT Downing Unique Opportunities Fund. In the previous episode, Judith and Rosemary shared some of their best investments, as well as some of their investments that didn't work out as expected. During this episode, Judith and Rosemary will share the highs and lows of meetings with company management, red flags to look out for, and their views on annual general meetings, more commonly known as AGMs. This was another great insight into how two seasoned fund managers think and how they view investing for the long term. Just before we get started, please remember that all opinions and information are for educational purposes only and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Judith. Hello, Rosemary. Good to see you again.
Hi, Lee.
Hi, Lee.
So this one's about AGMs and memorable meetings with company management. We're going to start with AGMs. But before we do get into AGMs, I thought it might be good for you to share with the audience what is an AGM, because to private investors, they are quite important, and it'd just be good to give a bit of an explainer for those who perhaps are new to this podcast and new to investing, what an AGM is. Judith, Rosemary, who wants to go first?
I'll give it a stab and then Rosemary can fill in properly with the real facts. So an AGM is the annual general meeting of the company, and it's the one time that as shareholders we get a vote or an opportunity to vote on what they call resolutions. And those resolutions could be anything from the appointment of the directors, how much the directors get paid, the appointment of their auditors, and how many shares they could maybe issue in a year. And Rosemary, there's probably other things as well, that are really important things that I've now just glossed over. But these are all quite serious things for a company. And therefore, I think it's quite important for shareholders to take them seriously and vote, cast their votes. And it's worth pointing out that it's about the number of votes cast, not the number of shareholders. So say if only 50% of shareholders turn out, and say 26% of that vote, so really, that's only 13% of the total equity that could influence that whole business, that whole resolution. So you really do need to stand up and get counted and have your vote counted. Whether you think you're a small shareholder or not really is quite important to be casting your vote at AGMs.
Yeah, it's also one of the things about an AGM is that all the directors turn up. So the chairman, the executives, non-executives. Usually they're all up for re-election every year these days. That's the best practice. But even if they're not, they all turn up to the meeting. And so if you want to talk to them, see them in action, that is the place that you can do it, even if you only have one share.
When you say re-election, what do you mean by re-election?
Directors are elected, they're proposed by management, but then that appointment has to be initially confirmed by shareholders in a vote. And then depending on the articles of association of the company, these directors will come up for reappointment every so many years. It used to be every 3 years or every 5 years. But these days, I say the gold standard that most companies would follow would be that each director is up for re-election by shareholders every year. So if the shareholders really don't want somebody, they can oppose. And if the majority oppose, then despite the wishes of the other directors, that individual can't be a director. It is a real power.
Yeah, it's really interesting. So can you just clarify then how the voting distribution works in regards to the share ownership?
There's a voting right attached to every single share. So if you own 10% of the company and you vote all the shares, that is 10% of the theoretical total votes. And if you have 1% of the company and you vote them all, you've got 1% of the theoretical total votes. You never get 100% voting anyway. So the outcome is the percentage of those who vote.
But what you find is shareholder lists are very fractured, quite wide in their structure. So you might have an institution like us that might have 2 or 3%, Rosemary might have 2 or 3%, and then you might have a flock of shareholders that are on platforms like AGMs or Hargreaves Lansdowne, but they might account together for about 18 or 20%, much more than any of the institutions. But because they think that they've only got, I don't know, £1,000 worth of shares or £500 worth of shares, they don't think they've got the same power as the institution. But actually, collectively, they're far more powerful than Rosemary or me or any other institution.
Listening to you here, voting is very important, and it's something that all investors should take a keen interest in. What sort of things do you tend to vote against?
There's several things. One is, as I say, you normally get to vote for the re-election of every director by name. So if for some reason you don't think that a particular director has done a good job, or perhaps they've not done a good job somewhere else before, and you've had experience of that, you are perfectly entitled to vote against their re-elections. That's one. There's several, but I'll give you a second one. You get to vote for the reappointment of the auditors, and it is possible that you might think the auditors have not done a great job. If there's been some evidence of poor controls, you might take the view that you don't think that they're doing a good job, or it might be that they're a tiny firm and you might be worried that this account is so large in relation to that firm that they might not be as independent as you like. That's a possible angle occasionally. That's the second one.
Another couple are a little bit more basic and go back to Rosemary's first point on whether the shareholder thinks the director is good or not. And that is also that you very often get the chance to vote on the director's pay remuneration. And that's your one chance to actually stand up and say, actually, we think this management team is too well incentivised. I know that management teams, even if it's not a vote that overturns the resolution, they're very sensitive to any vote against their remuneration, as you can imagine. The other one is a red rag to me is political donations. So companies have to disclose if they're making political donations. We invest in our companies to invest in their own businesses, not politics. So we would always vote against those that are making political donations of some sort.
And then there are some others which also sometimes exercise us. There's often these days some special resolutions towards the end of the list, and they have a higher bar to get through. So rather than a simple majority, they might require 75% rather than 50%. Those often relate to issuing more shares and circumstances in which the directors can do that. The ones which exercise us a little are where they want to issue shares without honouring preemption rights. So that means they can issue shares to selected institutions, and possibly private shareholders and even small institutions might not get a look in. And this might happen if they're suddenly going to do a big deal, or they got into difficulties and they want to raise money quickly. They want to issue lots more shares and not offer them to everybody, as in a rights issue. So they're going to just do a placing to selected people. They need permissions to do that. And that particular set of requests is something that if they ask for permission to issue too many percentage-wise shares, we often oppose that.
And do you vote on all your companies then that you invested in?
Some institutions, when it comes to voting, they subcontract. They leave the decision to somebody else. So they give it to a proxy voting firm. And we really believe that as shareholders, as owners of the businesses that we invest in on behalf of our own investors and our clients, that it should be Rosemary, it should be me, it should be my colleagues who are voting, because we've made the investment decision, and therefore we're the ones that should be making the decision as to whether the director gets appointed or how much he gets paid or she gets paid, or the auditors, etc. So it's very important for us to make that vote ourselves, a bit like a private shareholder would.
So do you attend the AGMs in person then, or have you ever attended AGMs in person?
Yeah, probably should do more, but not everyone. No.
Just a few. Often think I should do more, and it's a time issue rather than any other reason. I think they vary really quite enormously in terms of the value. So it's probably a bit of trial and error if you're going to start going to them. You'll find some that are more useful than others. Speaking personally, there are a couple that I have attended, which I find very useful. One is Games Workshop in Nottingham. They're a company that they have an excellent annual report, which I commend to people to read. It's very interesting, and they make all the normal announcements, but I would say they're not super forthcoming in extra presentations for people. They are a manufacturing business, and so if you can go to the AGM, you do actually go into the site, and sometimes you can get tours of part of the facility. But in any event, it's a company with a very distinctive culture, and you can pick that up much better by going along, and you can get to ask questions. The other company AGM that I've attended recently is called Judges Scientific, another excellent business. And really that's just around at the end of the formal proceedings around the votes, they invite people at the AGM to ask questions of any of the directors. And just that is a worthwhile thing. And then you can chat to individual directors afterwards as well.
That seems really beneficial. And I guess sometimes, even if you haven't got a question, but listening to the questions from other shareholders can be just as beneficial, can't it? As you mentioned there, you're both quite busy. You don't perhaps get to attend as many AGMs as you would like. What other kind of resources, or are there other ways that private investors can interact with management? They can ask questions, they can hear what the management are doing of said company. Are there other resources out there other than an AGM?
Yeah, there are now far more resources that private investors can use to get access to management teams. If you went back 10 years ago, you just wouldn't have the same access that you have now. And I think that's driven a little bit actually through COVID, because people are doing things more online, and management teams realised that they could access more people that way. There's an outfit called Investor Meets Company, which is one of the organisations that records company presentations for investors and also allows you as an investor to submit questions for the management team. So they will answer those questions on screen through this platform. So that's something that really only took off 4 or 5 years ago. And it's exceptionally powerful, because not only are you getting to see the investor, the institutional presentation, but you're also getting to ask questions of management. Companies are also now a lot better at doing capital markets days, where they'll let you come in and you can meet the senior management, but also the operational management as well, and see demos of products and services. So on the whole, I think management teams are far more open to engagement with smaller shareholders than they've ever been. There's still got to be room for improvement, and there are still those companies that are not engaging. Sadly, one of our investments, I was really disappointed to see that, I won't name them, but you might be able to guess who they are, but I was really disappointed to see that their AGM was in Middlesbrough at 9 o'clock on a Monday morning. That's not welcoming private shareholders to come and get there on time. So it's probably taught me to double check when AGMs are and how open they are to having private shareholders engage with them.
So as we move on to management then, what's been one of your most memorable experiences with management? That's positive experience and negative experience?
Yeah, had some howlers. I think you probably remember the bad ones more than the good ones, sadly.
I think that's true, actually.
Yeah,
I know,
yeah,
and it made me think a little bit about what really rankles me in a management meeting. And I think overarching is where a chief exec or a management team is really quite salesy and very high level, a bit patronising, and saying everything's great, because nothing's ever great. There's always something that you want to, or management team should be honest about. So that really rankles with me. But some of the worst ones have been actually with non-exec, where I've been interviewing non-exec directors or even chairs, where I've realised that they just don't have a clue about the business. Just really don't understand the strategy. They're clearly not engaged. They probably only pitch up to management teams, board meetings, and there's no interaction throughout the course of the month. And that to me is really disappointing. It tells me that it's not a proper, well-governed board with a chair or a non-exec that's actually helping the management team. And very often it's a management team that's actually pretty good and a company that's really nice. So to me, that's really disappointing, where you don't have that support and governance round about. And yeah, those have been sadly some of the worst ones.
I think the best meetings, and a lot of them are good, are where you learn interesting new things about the business. We're both quite a lot as long-term shareholders, so we're often seeing companies regularly over a period of years. And you might think, oh, most of the basics, but we don't think that. But it's always interesting when you have insights, fundamental insights that come out from a meeting. And I'll share something which is very recent. A long-term holder of the drinks company, AG Bar, Scottish drinks business. And the chief exec, who's called Roger White, is about to leave. And he's been there for, I think it's nearly 20 years and a very approachable, good steward of the business, respected. And I had what will be my final meeting online with the company. And actually I said, I don't really want to ask you about the minutiae right now, but as you're going, can you just reflect with me on what are the aspects of the business, the strengths of the business that keep out the competition? And I jokingly said, don't just say brands, because they've got a lot of brands. And it let out 20 minutes of very detailed insights into what makes that business capable of earning very good returns on capital. So that's an example of a good meeting. But one of my worst that I remember is a company that was coming to the market. And in the prospectus, it said that they had recently parted company with a chief operating officer. And it happened to be somebody I knew. And so I checked it out. And then the company came in and I said, oh, why did this person leave? And the chief executive said, oh, she wanted to just move into non-executive roles. And I absolutely knew that he just lied to me. Absolutely, without a shadow of a doubt, because I had actually checked it out with the person in question. And that's it, really. That's the complete turn-off, isn't it? A blatant lie on a roadshow.
That was a red flag.
Yeah.
Massive one. Yeah. I suppose the benefit of being around, having been around for a while, both of us will probably know names or be associated with names of people that have been in the market. So therefore, we've got the benefit of being able to reference quite easily. And so a management team should never think that they can get away with, lying.
Yeah.
So moral of the story, don't lie to Judith or Rosemary, because you'll get found out.
And we won't be happy when we do find out.
The meeting there, you were with the chief exec of AG Bar. Was it just you on the meeting with him, or was it like a multiple?
It was just me. We have meetings that are one-to-one and we have meetings that are group meetings. And it depends a bit on the company and how diaries and how busy they are, how busy we are. And also there is some correlation with size. So the bigger a company, the more likely it is to offer group meetings to all but the very biggest of their holders. And you can understand that if you are say you're a FTSE 100 company, you've got so many shareholders, even institutional shareholders, that practically speaking, it's quite difficult to speak to them all one-to-one. So I think there is a correlation there. Where Judith's got strategic stakes in things, I should imagine she almost always has one-on-one.
Yeah, and we're probably slightly further down the market cap curve, so I would say about 80% would be one-on-one meetings.
So you've met a lot of CEOs, you've met a lot of founders. What type of characteristics stand out to you as somebody that you think, yes, this individual can lead this company, they can actually execute on what they're saying here? Are there any characteristics? Are there any commonalities? Have you seen a pattern in individuals that lead companies to long-term success?
I suppose it's really simple as being able to articulate their strategy. It's up to us whether we like that strategy or not. And then a track record of being able to deliver on it and being accountable. And you can find out about that through the accounts and going back a few years and seeing what their KPIs are and then referring back to see how do they say what they do in the tin, or do they do what they say in the tin even?
And they don't lie.
And they don't lie, yeah. Always helpful, fundamentally. Yeah, reputation and integrity. How do you describe integrity? I don't know, actually.
I think I'd make one other point, which is not to disagree with anything that Judith has said, but there is another angle, which is that the quality of the business is often more important than management. Warren Buffett famously said, so paraphrasing rather than exact, that if you've got a really good manager running a business in a terrible industry, it's the business that wins out.
Yeah.
And I think that's right. And I mean, it's worth recalling that Berkshire Hathaway was a textile business and he found that out the hard way. So no matter how good the management, if you're dealing with a business which is either structurally challenged or doesn't have many things going for it, it doesn't matter how good you are, it's going to be a real struggle. Similarly, and we might fall for this, there might be some really excellent business. We might think that the management's excellent, and it is possible that they're just pretty ordinary, but they're running a very good business.
You got lucky.
It's not always easy to tell.
I suppose red flags as well might be something to look out for, might be sometimes charismatic individuals can sell a story, can't they? But I think what you've just described there is, yes, the management can be everything and hopefully that what they say they are going to do. but look at the company as well.
Yeah, that comes first. And that's probably why we spend a lot of time doing the desk work and doing the reading and everything else to try and establish the quality of the company, and it helps with the integrity of the management as well in terms of what you're reading from them. The last bit really should be the management aspect and meeting the management, because it's so easy, and I'm sure we've all done it, but it's so easy to get your view distorted by a charming management team. And therefore you've got to draw yourself back to the facts, not the fact that you might like to go out for a drink with somebody. That's not what you're investing in.
So we've mentioned CEOs, we've mentioned management. What about founder-led businesses? Because I know you're both really quite enthusiastic about founder-led businesses. What are the characteristics of a founder, and why is it that you're particularly drawn to founder-led businesses?
I think there's two types. One's good, one's bad, sadly. And I've managed to make the judgment on the bad one, thinking they were good, and maybe the other way around as well. So I maybe speak from experience in this. But you're right, we do like companies where they've got skin in the game, where management teams have got a decent amount of equity themselves, because that creates hopefully alignment with us as shareholders. We're all hopefully in it to make a good return. And therefore they tend to be quite good at allocating capital. They're not frivolous. So that's why a founder can be a good person to back. But I've also found that they've got some characteristics that aren't quite so attractive. And that can be that they don't like challenge. They see it as their business. And there are some red flags that I've learned to look at as you go through your due diligence. For instance, does the financial director, when you ask the FD a question, is it the founder that answers the question for him or her?
Good one, yeah.
That really annoys me, because it's clearly they are not trusting their FD to have a voice. And that's dangerous, very dangerous, because it's the FD that should be the one that calls out any discrepancies in the numbers or whatever. So sadly, I've seen founder shareholders who have got that dominant position and that dominance over the board where you can see more fraud, or I've come across more fraud in those types of companies. So although they can be great and really pushing for the growth of the company and absolutely dedicated to the company, that there can be some negative traits. You just have to be aware of it. They're also not very self-aware sometimes. And by virtue of them being founders, they might have been there for quite a while, and therefore sometimes they don't know when to move on. And if they've got a board round about them that is not capable of saying that their time is up and maybe it'd be good to get some fresh blood in, then they can tend to hang around for too long sometimes as well. And if they've got a big shareholding, say they have 26%, so going back to that voting, if they own 26% of the shares, then they can block any other shareholders saying maybe a special resolution to remove him or her. So they can sometimes wield just a little bit too much power, but maybe I'm jaundiced by this. And Rosemary's hopefully going to come out with some good examples of why backing founders is a good thing.
So if you gave me two companies coming to the market and one was founder-led and one was coming out of private equity, I would go for founder-led every time.
Yeah, so would I.
Because usually then the reasons for coming to the market for a founder are, it may be that they want to slowly reduce their holding. It may be their opportunity over time to exit a business. But if that's carefully managed and they're patient, that is fine, providing they've got management succession evident. But it is sadly too often the case that private equity bring highly cyclical businesses to the market at the top of a cycle. And we're clearly the mugs that are supposed to take those off them. And often they'll also bring them with loads of debt. And the valuation assumes they've got virtually no debt. And there is a non sequitur in there that you've got to float in order to get the valuation. So we're facilitating that valuation, but it wouldn't be that valuation in its existing indebted form. So there's an often lot of double counting or double think in this. So I think I much prefer the founder business, or indeed the family business. Where there's significant family stake, it could be historic. Because there tends to be longer term thinking, and as Judith said, more alignment of interest. So it's back to the incentives. Whereas the founder, particularly if they've got a reasonable holding, will be doing things for the long-term health of the business. Even if they get it wrong sometimes, that's the objective. Whereas a hired hand is often just looking to the next payout in 3-year horizons, and capital allocation decisions aren't always made in ways that we would prefer.
There's so much to think about when investing in a company, founder-led, professional management team, family-led. You can see how that thinking, shall we say, mother or the father is running the company, and the succession plan is for their son or daughter or nephew or niece to step in. You can see that they're going to do the best to make really long-term decisions, aren't they? And that does happen, doesn't it? James Halstead is a classic example of that. Been going a lot of years, haven't they? Multiple decades.
Yeah, Andrew Sykes, another one.
I mean, I think that the majority of second generation of family businesses are not the best people to take over. There are honourable exceptions, absolutely, but not always. But yeah, I mean, if you look at Dunelm, the Adderley family still own roughly half the company. Been a fantastic success story I think it's founded in the late 70s, early 80s. I mean,
and are they still involved in the actual management of the business?
So the founders, no, they're of an age where they're not employed. There is a son who is involved in the business, I think with sourcing and things like that, where he's very knowledgeable, but there is a professional chief executive in there, Nick Wilkinson, who is excellent. And one of the ways that manifests is that, like a lot of family businesses, when they got going, they bought freeholds. So they have a far higher percentage of freehold shops than the competition, which is a huge competitive advantage.
Yeah, so they actually own the buildings that they're selling the stock in.
Not all, but I'm going to say roughly half, on top of my head.
Yeah, that's really quite clever. It's good foresight, isn't it? And what do you think the landscape for UK businesses coming to the market is? Having your finger on the pulse, what are you seeing as a trend in UK businesses coming to the market? Are you optimistic or slightly pessimistic?
I think you've always got to be optimistic, because if you're optimistic, you can hopefully point to what can change and help it happen. But I'm sadly still a little bit pessimistic. In the short term, I think we've got some really good quality businesses, but the market at the moment is not really servicing them that well. And that's got a lot to do with the whole ecosystem, and it's including investors. So there's been a number of months, 36 months now, where there's been outflows from investment in UK companies, and that's got to reverse. And there's ways of making that reverse, including encouraging more people to invest in this area. And I think that is happening. Beginning to happen, but for me it's probably not fast enough.
And there was an absolute dearth of companies coming to the market last year, and the year before that, around COVID, a lot of the businesses that did come proved to be really bad investments, which is not encouraging to people who might have invested in them and had their fingers burnt. So it's not been a good 2 or 3 years, actually, but that doesn't necessarily mean it's forever. The thing is, Lee, that while a lot of institutions have been selling out of UK equities for various reasons, it's possibly other investors have been perhaps moving more money to the States or wherever, we're sitting here busy watching corporates and private equity bid for UK companies. In the week that this is being recorded, we've got 2 companies that have had 2 bids each.
So there is interest in UK companies, but just not from UK investors.
Yes.
Investors. Yeah,
absolutely.
Right. Everybody else thinks that UK companies are cheap and really good value and good quality. The UK investor is the one that's sitting on their hands, which for me is the frustration.
That's interesting, isn't it?
It needs to change. Yeah.
So private equity are coming in.
These ones that I talked about, they're all trade buyers. One's in the paper industry and one's in the telecom testing industry. In both cases, the 2 bidders, I think, are both from the industry. So it's not.
So they've got real insight.
Thank you very much.
Yeah, they've got real insight from the same industry.
Yeah, they do.
So as we always finish off with every episode, one worthwhile book or a podcast to listen to.
So I was just going to highlight a book which, for anyone who spotted that it's on the reading list that I think you, Lee, have put out on the site, which we put together. I thought I'd just talk about it. Great fan of investing in what's known as quality compounders. And a book that makes the case for that very well is called Only the Best Will Do by somebody called Peter Silern, who I think runs funds, probably more globally than I do. I just found it a very readable book. He makes the case for investing in businesses with very good returns on capital and then being patient and letting them do their stuff. And the emphasis is that this method really does only work if you're prepared to take the long view. Yeah, but it's a good read.
That list that Rosemary just mentioned there, if you scroll down to the show notes in all these episodes, the link to download that PDF, it is there, so you can download it and enjoy many other books that the Downing Fund Management team have recommended. Judith, final thoughts?
Yep, mine's not a podcast and it's not a book. It's actually a set of reporting accounts, and it's for a household name that you may have come across. It's Next PLC, and I always quite enjoy. I'm not a shareholder, but I've probably read the reporting accounts for the last I don't know how many years. And why are they good? Why would they be bedside reading? I think they're just a really good example of a well-written report and accounts. And we've talked about management teams being accountable and how they describe how they're reacting to maybe the macro or technology changes or whatever. And this business, they write 72 pages, I think it is, of narrative on how they run their business, and also a divisional split. What the thread running all the way through it is how you as a shareholder are going to generate returns. And so everything gets pulled back to that, making new investments in their business and how that will generate returns for the shareholder. And it speaks to not just an analyst or an institution, it's got many layers within it. So you can get a high level approach. And then as you go through it, it digs deeper and deeper, and it leaves you asking or wanting nothing. You could probably read that document and never speak to management and not be tainted by having spoken to management, because you can see exactly what their strategy is. They map the last 10 years on return on invested capital, their working capital management, all these financial metrics, but they then draw it back to what they actually did when things didn't go quite to plan and why maybe inventories, stock levels have gone up in that particular year. And then they've got a section at the back for analysts. So if you're a real geek, then you can delve into the real detail on the financials. And they're almost letting you do your own financial analysis with the information that's there. And yeah, as you can tell, I quite liked it.
Quite excited there.
Yeah, I got quite excited by a set of report and accounts. But not every company would ever go into that much detail. But I think I really respect them for doing it, because that accountability is there year on year.
So this was a podcast about management and AGMs, but you just said there you can read the annual report for next and you not need ever meet the management. So good set of accounts. For me, these episodes have just opened up a window into your world, and I really appreciate you for agreeing to do this. To me, I found it so interesting, and I just get this insight into a day in the life of, we're coming to the day in the life of a fund manager, aren't we? We're coming into that. But just an insight into how you think, how you view companies, and just your vast experience. It's been an absolute pleasure. And we've still got 2 more to go as well. We've got portfolio management and construction, which is the next one. And then, as I said, a day in the life of a fund manager. So thank you very much.
Thanks, Lee.
Pleasure.
Well, that's it for today. In our next episode, Judith and Rosemary will share their views on portfolio construction and portfolio management. Identifying a good company to invest in is one thing, but it's quite another to manage a portfolio of them. It will be another insightful episode that reveals how 2 seasoned fund managers think and how they view investing for the long term. To learn more about Rosemary, Judith and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. And if you liked what you've heard, please subscribe and leave a comment. The more feedback we get, the more value we can offer. Thanks for listening, and we look forward to speaking to you in the next episode. Hope you have a great day, and bye for now.